Hey there, awesome accounting student. Mark Franke here. This is a second video for Chapter 2 for Accounting 101. And in this video, we're going to look at the balance sheet, analyze the equity section, and calculate net income, and also talk about the debt ratio. So, the first thing we always want to do is on every single schedule, put our name and the problem number. This is problem 2-5B. And this problem is on page 79 of your textbook, page 79. Because the balance sheet really is the thing that accountants focus on. Because if we get the balance sheet correct, the net income and the change between the equity section has got to be correct. So that's why the balance sheet really is the accountant's statement. This is Tama Company, and this is a balance sheet. We are going to prepare two balance sheets. And we're talking about December. In fact, let's put in, there we go, December 31, 2018 and 2019. We're doing 2 years. 2 years. Now, I'm just taking this directly from the information that was given to us in the book. So in 2018, we had 30 grand in cash, 35,000 in accounts receivable, 8,000 in office supplies. Total that up. We have current assets, 73,000. Always need to separate current and long-term assets. Office equipment, 40,000. Machinery, 28,000. And we don't have any building or land, so we total that up. We get total property and equipment of 68,000. And if we add that together with current assets, our total assets are 141,000. And by the way, I've given you a worksheet in Canvas that you can use to follow along if you'd like. I would suggest doing this in pencil and uploading it if you want the points. Current liabilities, we've got 4,000. We don't have a note payable, and our stockholders' equity, we have to calculate that because we know that total assets are 141,000, so our total liabilities and equity have to be 141,000. So if we take ending liabilities and equity and subtract the accounts payable, we can calculate 137,000. That's our ending stockholders' equity. So our balance sheet is going to balance because we made it balance. We were not given stockholders' equity. We had to calculate it. So for 2019, we have 5,000 in cash, 25,000 in accounts receivable, office supplies 13,500. Our total current assets in 2019 dropped to 43,500. We've still got 40,000 in office equipment. We have 28,500 in machinery. We have 250,000 in building and 50,000 in land. So our total property and equipment jumped up to 368,500, and our total assets are 412,000. At the end of the year, at the end of 2019, we had 12,000 in accounts payable. We had a note payable of $250,000, probably related to the building that we bought, which means if our ending liabilities and equity is 412, our stockholders' equity has to be the 412 minus accounts payable minus notes payable. Again, I'm calculating stockholders' equity based on the fact that the balance sheet has to balance, which means that our ending stockholders' equity is $150,000. So now I've got my two balance sheets side by side, and the first thing they've asked us to do is to prepare a schedule to calculate net income. So over here, I'll say this is calculation of net income. We have our beginning equity, which is $137,000. We have our ending equity, which is $150,000. So the change in equity is $13,000. It went up $13,000. They told us in the problem that capital contributions were $5,000. So if capital contributions went up $5,000 and that made equity go up $5,000, right? We're trying to get net income. We have to subtract that capital contribution to take the effect out. This is similar to what we did in chapter 1 in that 5 company side-by-side thing, right? We're adding back capital because we're trying to find net income. We also have to, we're subtracting capital. We have to add back the dividends that were paid. Dividends that were paid is $3,000. So we're taking the effect of that out of the equation. And so our net income is $11,000. We took the change in equity. We subtracted out the capital contributions to take that effect out. We added back the dividends to take that effect out, and our net income. Now we can prove this by basically doing a statement of stockholders' equity, because we have beginning equity of $137,000. If we add our capital contributions of $5,000, if we add our net income of $11,000, and we subtract our dividends of $3,000, we should end up with our actual ending equity of $150,000. And let's see if that works. And it does. So we've proven that $11,000 is the correct number for net income. So the last thing they've asked us to do is to calculate the debt ratio. The debt ratio is total liabilities divided by total assets. In other words, our total debt divided by our total assets is going to give us our debt ratio. This is basically a percentage of the liabilities to total assets. So if we calculate total assets is 412, and our total liabilities is accounts payable plus notes payable, that's $262,000. If we take total liabilities and divide it by total assets, we get 63.6%. So in other words, if we, for every dollar of assets, we have a liability that's worth about 64 cents. 64% is not particularly high. Again, if you think about this in terms of the apartment building in Bellflower I talked about, or even a house, if you have a house that's worth $412,000 and you have a mortgage that's $262,000, then your debt ratio on your house is going to be 63.6%, or the reciprocal is the equity ratio, which is going to be 36.4%. The reciprocal is 100% minus the debt ratio. Okay, that's it for this one. I know we went through this very quickly. Practice, practice, practice. Get chapter 2 done, and I'll see you next time.